Today let us discuss about the objectives of financial reporting. What is financial reporting? Financial reporting is how organizations tell their financial story. It's the language used to communicate business performance and position to various stakeholders. We have main financial reports, and the main financial reports are your balance sheet. We have the income statement, cash flow statement, and a statement of changes in equity. Balance sheet shows financial position at a point in time, and other statement like the income statement, the cash flow statement, and the statement of changes in equity shows financial information at a period of time. The balance sheet is also known as a statement of financial position. It provides information about the entity's resource structure. The entity's resource structure are the assets, and the financing structure is the liabilities and the equity. The balance sheet consists of three elements, which are the assets, the liabilities, and the equity. Asset is what the company owns. They are the resources of the company. Liabilities is what the company owes, and equity is the net worth. And the equity is also the difference between assets and the liabilities is also called equity. Income statement. Income statement is also known as profit and loss statement. The income statement shows the results of operations over a period of time, and the income statement uses accrual accounting. So what information do you get from the income statement? You get the revenues, you get the gains, you get your expenses and losses. So when you combine your revenues and gains less your expenses and losses, you are going to get the profit or loss of the business. The income statement consists of four elements. We have the revenues, we have the gains, expenses, and losses. Cash flow statement. Cash flow statement is also known as a statement of cash flows. The statement of cash flows shows your cash receipts and cash payment of the organization or the company, or in other words we can say that it's the cash inflows. You get information about your cash inflows and the cash outflows. Now we have a statement of changes in equity. A statement of changes in equity shows honest investment, distribution of profits to owners, and the profit retained by the company. So this is the main financial reports. Now you can understand what information do we get from these main financial reports. So what information we are going to get? We are going to get the assets, or we are going to understand the assets of the company. We'll understand the liabilities, and we are going to understand the equity. So asset is what the company owns, liabilities what the company owes, and equity is the net worth. We can, from the income statement, we can know the profit and loss of the business. From the cash flow, we can understand the cash inflows and cash outflows, and from the from a statement of changes in equity, we can understand what owners has invested into the business, what distribution of profit they have made, and what profit has been retained in the company. So these main financial reports have certain objectives. So let us now move towards the objectives of these financial reports. It focuses on the informational needs of the external users. It provides information that is useful to potential investors and creditors and others in making rational financial decisions regarding the enterprise. So this means what the users can make smart decisions. So the investors, by using the financial reports, the investors can invest into the business because they know everything, and the creditors can lend the money to the company. The other objective is that it helps the parties in assessing the amounts, timing, and uncertainty of prospective cash receipts from dividends or interest, and the proceeds from sale, redemption, or maturity of securities and loans. So the users can understand the cash flows. So it is just like the cash inflows and the cash outflows. So the objective is also concerns about the economic resource. The economic resource are your assets, and the claims are the liabilities. and the effects of transactions and events and circumstances that change its resources and claims. So the users can understand what the business owns and what the business owes. So this is what the objectives of financial reporting is. So what are the objectives? The objectives can be memorized that it helps to make a smart financial decisions. It helps to predict the cash flows, cash inflows and cash outflows. It helps to understand what the business owns and what the business owes. Users of financial information. There are a variety of users and stakeholders that depend on the financial statements to determine the financial position and health of the organization. These parties can be within the organization or these parties can be outside the organization. So there are two broad groups of users of financial information. We have the internal users and external users. Internal users are inside the organization, and the word itself suggests that they are the persons working within the organization. They make actions and decisions pertaining to internal activities of the business, and the examples of internal users are board of directors. We have the management and employees. External users. External users are outside the organization, and they are the business enterprises or individuals who have interest in the business, but they do not directly involve themselves in the daily activities of the organization. And the examples of external users are shareholders and prospective investors. We have the creditors, suppliers, financial advisors and analysts, customers, competitors, and the regulators.